So this is Vasa Dental City or DENTALKART. Um, Main highlights for FY24 are that they have increased their customer base by 31%. They have witnessed around 76% customers return rate. So their return customers, currently their average delivery time is less than 4.5 days, and they want to bring it down to 2 days to to compete with the um, traditional stockists or suppliers of dental products for tier 1 customers and also tier 2, tier 3 customers. They have around 1800 unique dental product and in FY24 boarded around 450 brands in the platform, stringent quality measurement and 3.4% return rate, etc. This is the financial highlights for FY24. Uh, Managing Director, ignore. So revenue split, we can see. So their revenues have grown impressive from FY22 to 24. EBITDA has also grown 4x and PAT has grown 3x. So somewhere between PAT and EBITDA, there is something that is gone. Uh, Then EPS growth has been decent and marketing expense, again, that is kind of growing a little, but I think it will also keep growing. Monthly active user is pretty decent. I mean, almost double. And monthly active user kind of means that anybody who's coming and clicking on the website. So maybe a dentist comes and clicks 10 times, so it will be 10 times would be added. This is one of the trigger. They are going into warehousing and reducing the average delivery days by optimizing those warehouses, etc. So currently at 4.5 and maybe next year or so, it will be 2. Average order value is slowly inching up to 4030, and probably this will also increase going forward. Order growth, so from 2 lakh order to almost 4 lakh orders, so almost 100% jump in 2 years. Own portfolio from 46% to 53.7, and this has a margin, gross margin of around 50%, and they want this to go to 70% of the overall portfolio, but not at the expense of the traded items. They are going ahead in warehousing, so almost 3x warehousing space, and they are not going to increase this more, but rather optimize and use it. So key metrics, SKUs are decent. Brands, they have increased their brands, I mean, increased by 50%. Total customer base has also sort of doubled, and unique customer has increased by 50%. Um, we can jump through this. So here they talk about various things. Basically, they are, I mean, mostly 90% online and 10% offline, I think, sort of a setup. And you can go to the application or the web app and buy dental products, which you usually don't get. So, and the target customers are independent dentists with 1 to 4 beds. They have not yet targeted this group, colleges, hospitals, corps, and all, and this could be a very, very big segment and also very price sensitive segment. Uh, and yeah, I mean, their employees and all, 300 employees and brands and everything. So this is the journey. So 2016 they opened, and 2024 they have around 173 crores of revenue. And in between 2017, I think it was an app, and then they launched, sorry, 2018 they launched an app, and then they set up a warehouse by 2020. 21 they set up another warehouse, and then they got listed in 2023 February, and from there 2024. Yeah. And promoters and the team, I can ignore them for now. So these are the various brands that they cater to, and so what is the advantage? They talk about various advantages over here. One can read. This is the distribution system. So you have OEMs and brands, direct, distributor, or retail. Um, DENTALKART procures from them, and then they store it in their warehouse, then they distribute it through their warehouse to the dentists, and they keep a track of what are the items that the dentist needs at what time and all of that. And they say that there is little to no innovation in the pre-existing market, and there is only state-wise distributor that leads to arbitrage in product pricing, so they can provide cheaper, and cost is a very big important thing. Also, local stockist holds up to around 1,000 SKUs, whereas DENTALKART has around 1,800 SKUs. Over here, disruption is the biggest thing. Uh, Fully integrated, uniform pricing, quality assurance, pan India, 1,800 SKUs, 450 brands, and they aim to deliver by 48 hours in 48 hours. This is the split. Gurgaon, they have 20,000 square feet, and then Delhi, Bangalore, Kolkata, Nagpur, Guwahati, these are smaller. But I think Delhi is the largest, and they are focused on this market mostly. Uh, then delivery time, warehouses, operation, logistics, and all of that. Um, then you have all this. I mean, this is the tech infra, web, customer, then micro, this thing, format, real time data collection, and all of those things. And I talk about this microstructure and ignore. Then you have all this procurement, blah blah. Then, I mean, because this is again, they have to track via website, so all of these things are important. Influencers and apps, and I don't know, dentist influencer. And then these are some of the trade shows that they went, how they are going to increase, and we'll see. I mean, from the commentary, what is the position. Online portal, gem portal, other online marketplace, but they directly converse with dentists and not with customers. So they don't sell tubes and, I mean, toothpastes. Now going to the valuation part of it, um, the order growth had been 35.94%, monthly user growth has been 93%, brand onboarded 36%, so for 50 brands. Average delivery days is 4.5, and probably by FY27 they should be around 2. But I think this would be earlier, and this will improve their margins and the sales quite significantly. So the split between their own brand revenue is 54% and 46%, um, and the volume is 21% and 79%. So the traded volume margin is very tight, and own volume, the gross margin is around 50% over here, and traded volume margin is 15%, and maybe EBITDA level that would be 6 or 7% maybe. Um, so now their sales, what this year they have done 172 crores. If I assume they do a 40% sales growth next year, it'll be 240, and then again 40%, 337. However, management has said that they should be doing 70% sales growth this year. That is in May con call, but we'll have to see. Then by FY27, it will be 550 crores, and then by FY28, they say that they can do 800 to 1200 crores, and this is somewhere over sales trigger. Let me find it quickly. Uh, Yeah, over here they talk about guidance of 800 to 1200 crore turnover by FY28. So this is interesting. Wait, going back now. So I just tried to calculate the gross profit. I mean, taking these variables, and it feels like they would do around a gross profit of 33 to 39. But Screener says that the gross profit margin is 27%, and FY24 is from the management commentary, these numbers. So we have to check how this is. I mean, these numbers, this 50% and 15% is from the management commentary. And then the fixed cost, I mean, around, if I feel, I mean, as the business grows from 172 to 500 or 800, uh, the fixed cost has to increase, and the management has not been very clear about the operating margin, and I'm not sure whether the operating margin or operating leverage will play out. So I think 13% is what you can expect as the business grows, but it can go down to maybe 10% also because management will focus on growth and there could be significant marketing expense. I should add that. And this is one of the reason for valuation. I've taken price to sales and not all of these bottom lines because it can be very, what do you call, noisy. And so yeah, and logistic cost is around 3.5%. So I feel this is a variable cost and this should not increase. Maybe it would decrease but not increase. So EBITDA percentage maybe around 13%. Depreciation not so much and other income not so much. In fact, this will vanish and depreciation will also it'll stay one. I mean, because they're not going to increase their uh, warehouse, I think, to reach that number. PBT comes to this and PAT goes to this. So PAT growth, we can expect like year on year, it'll be pretty significant growth. If I try to find out the CAGR, let me, okay, no need to find the CAGR, but I mean, it should be pretty decent PAT growth. And I've assumed the tax of 25%. One of the risk is inventory write-off due to high inventory and all of those things. There could be some other risks also. So okay, ignore this one. Let's just delete this. We can have, I mean, if you have median 3-year upside, if you or maybe current valuation can be for 50% or 40%, depending on the company's execution, if they are able to execute or reach 500 crores. But even if they are, say, at double the this thing, 350 crores, you can still have a 20% upside over here, yeah, for 3 years time frame. So looking at how everything is placed, it doesn't seem like that. Industry insight, so around 33 lakh 50,000 dental practitioners with 5,000 dental laboratories and 352 dental institution. Also, most of the dentists are individual dentist practitioners who have either one, two, or three, four private chairs. And currently, for a very few dentists, they are the primary source of buying. But like most of the products, the people who are in tier three, four, uh, for tier one cities and tier two cities, they are generally the secondary source of purchase because they are already existing stockists. But these are the guys who they disrupt, and they by becoming the primary source by bringing in value and cost. Majority of the revenue comes from tier one and tier two cities where they are the secondary guys, or it is coming from tier three and tier four. So tier two and tier three majority of revenue comes, and tier four is not is a problem because they're not delivering fast enough. And tier one there is traditional supply chain. On the sales trigger front, there are various things that the management said. First is targeted marketing campaigns. And this year they were not very happy with 40% growth, and they said that they'll do 70% growth. The one of their German JV Baldus, their nitrous oxide sedative, that they're becoming an exclusive distributor, and the TAM is not just dentistry, it's also derma and other things as well. So that should be something to be looked at. And then, yeah, I mean, this was one, and then by I think next 3 years, 500 to 600 crores, and they are in the direction. So I took 550 crores, but maybe if I take lesser, also the growth is decent. And also, uh, they see that people are going to dentists are going to shift from a MR system to a more digital system through which they can buy many things. And yeah, I mean, this is what they are saying. 80% of the orders needs to be delivered faster. 20% of the orders only get to the dentist at their faster speed. So maybe they'll use some analytics to do this. 98% comes from individual dentist practitioners, 2% from hospitals. For hospitals, they need to give them credit, so they are looking for a good financial partners who can take up this credit. And also, hospitals will be bulk order quantity, so the revenues will shoot up if that happens. Also in the Army Dental Corps and primary healthcare centers. So this is a very, very big market. So Yeah, I mean, they talk about the uh, cash on delivery, so that's almost 50%, and I think PK is uh, previously paid or something. I'm not sure what this is. Um, then yeah, this is very important. Uh, they talk about revenue. So second source, majority of the revenue is coming from large customers who are keeping us as second source because they are not able to find products locally or are able to find lots of new products on our website which they want to buy again and again. For example, dentist purchases worth 40,000 consumables in a quarter. And so most of the common consumables like dental stone, alignate, they prefer to buy from local dealers, but some product may be worth 5,000, 6,000, they buy from DentalKart, which they're not able to find locally. So this is the situation. And currently the target is to get to 4,000 worth of revenue for every dentist from the 600. So this is almost 6x growth. Yeah, it's a very large TAM. This topic is very important. And 500 to 600 next 3 years, I think they said like, oh, we'll do it and we'll even go further and make it 800 to 1200. I just took 800. If it is 1200, then it will definitely go to out of whack valuations. Going ahead, what growth are you looking at? So somebody said 40%. They said, no, we'll grow at 70 to 80%, 75%. And then they are serving half of the dentists and half of them are not. So they can always increase the quantity that is they are serving to them. So there's a 10x upside. So even if they do 5x from here, that's the top line growth by 5x. So significant upside potential because they're very small in a very large pond. There are around 320,000 approximately registered dentists and 1 lakh unregistered dentists, 350 dental colleges, blah, blah. On the margin front, they give some good details. One is um, how they are going to increase or improve their customer servicing by reducing the turnaround time from 5.5 days to 4.5 to below 48 hours, so 2 days. And this is going to be via tech infrastructure, ERP systems, and this will also be one of the trigger for good revenue growth. Then on the receivables, so receivables, they said that 15 days of receivables, which is again bad for working capital, but that is the way it has to be. Cash on delivery is like 70% of the receivables and around 8 crores. And this is not a bad debt, but then it goes to the delivery agent and then he puts it in the system or the logistic partner and he puts it in the system in 15 days. And business to business or business to government is around 30%, so around 3 crores of delivery. And I think this is longer than 15 days. On warehouses, I think the warehouses are mostly done, and now they are going to focus on turnaround times and reduce inventory days and manage inventory, understand what is needed where, and then focus on that. Yeah. Then B2G, I mean, they are also going into offline channels, and total online order is 98%. Uh, I mean, out of the total online order, 98% is B2C, and 92% is online, 8% is offline. Um, B2C is 90% and B2G is 10%. So they talk about rapid expansion in warehouses and how are they going to spend their cash as well. Uh, Here they talk about inventories and they say that how they use clearance sales to sell off their inventory even at lesser price. So they are tracking that good, and hopefully their own product portfolio goes from 54% to 70%. uh, Margins are 50 to 15 ratio. So 50% is for the own product and 15% is for the traded product. Then this is the gross margin, and it can EBITDA margin is low. Uh, and they don't manufacture anything; they import everything. They might go ahead with some assembly work. And then they talk about Gujarat and ERP system microstructures. Logistic cost is 3.75. So this is it. I mean, overall, if everything works, then I mean, if they are able to deliver 1200, maybe out of whack valuation, even if I take 1000, then also pretty good number will be achieved if they are able to crack that. Just a second, where is it? 144% CAGR growth. And if they are able to crack 1200, then oh, forget it, 155% for 4 years CAGR growth and 41x. But let me take a conservative number of 800 crores, and you will see that they will do pretty decent, almost 27 times in 4 years. And if they're able to do 550 crores, and yeah, this is for out of bag valuation, but let me take the median valuation. Here we see a 3x growth in 3 years and a 5x growth in 4 years. So I would say this is pretty decent. The green ones are where I have put in my numbers, and then the yellow ones are my assumptions and corrections. So yeah, this is about it.